Every single person who lost everything in 2008 thought they were safe. Not just regular people, smart people, bankers, economists, government officials who literally wrote the rules of the financial system. They all looked at the same data, ran the same models, and came to the same conclusion, that things were fine. They weren't fine. And here's what nobody talks about. The crash wasn't a glitch in the system. It was the system working exactly as designed. That is an uncomfortable thing to say out loud. So let's say it again, slower. Economic booms don't just end in crashes, they produce them. The same forces that drive an economy upward, confidence, credit, speculation, momentum, are the exact forces that eventually detonate it. And the longer the boom lasts, the bigger the detonation. This isn't theory. This is a pattern that has repeated itself with almost mechanical precision for over 300 years. And right now, in 2025, every single ingredient is on the table again. Let's go back to a Tuesday morning in October 1929. The New York Stock Exchange had been on a historic run. For nearly a decade, American stocks had climbed so consistently that entire books were written declaring the old rules of investing no longer applied. Yale economist Irving Fisher, one of the most respected minds in the country, announced just days earlier that stocks had reached a permanently high plateau. 5 days later, the market lost 23% of its value in 2 sessions. Within 3 years, it had lost nearly 90%. Millions of Americans lost their savings, their homes, their businesses. The Great Depression had begun. Irving Fisher lost his personal fortune. He spent the rest of his life trying to pay off his debts. Now fast forward to 1999. Technology stocks were doing something that sounds absurd in hindsight. Companies with no revenue, no product, sometimes no actual business plan, were being valued at billions of dollars. The logic was simple. The internet changes everything, and whoever gets there first wins. Analysts called it a new paradigm, a new era. The old rules did not apply. The Nasdaq peaked in March 2000. By October 2002, it had fallen 78%. Trillions of dollars in paper wealth had evaporated. It took 15 years for the index to recover. Then 2008, then 2020. And between each of these moments, a boom, always a boom, always the same story about a new era and permanently high plateaus, and why this time is different. It never is. So why does this keep happening? The simple answer is human psychology. People get greedy, prices go up, and eventually reality reasserts itself. That's true, but it's also the laziest possible explanation. It tells you nothing about the mechanics, about why the crashes are so large, so sudden, and so devastating every single time. The real answer lives inside something called the credit cycle. Here's how it works. When an economy is growing, 2 things happen simultaneously. First, people feel more confident. They spend more, invest more, borrow more. Second, banks feel more confident. They lend more at lower interest rates to borrowers they would have rejected 5 years ago. These 2 forces feed each other. More lending means more spending, which means more growth, which means more confidence, which means more lending. This is the boom, and it feels extraordinary from the inside. Now here's the part that gets interesting. As the boom continues, something subtle happens to risk. Not the actual risk, that stays roughly constant, but the perceived risk, it shrinks. After years of rising prices and positive returns, investors begin to unconsciously assume that the recent past is a reliable guide to the future. They forget that the good times were not always good times. Economist Hyman Minsky spent decades studying this exact phenomenon. His conclusion was bleak. He argued that stability is destabilizing, that the longer a period of economic calm lasts, the more fragile it becomes, because each year of calm encourages more debt, more leverage, more risk-taking, until the entire system is stretched so thin that almost anything can snap it. He called the moment it snaps the Minsky moment. You may have heard that phrase in 2008. That was not a coincidence. Now let's talk about the math that nobody wants to show you. When an economy is in a credit boom, total debt, government, corporate, and household combined, typically rises far faster than the economy itself. In the years before 2008, American household debt alone doubled in less than a decade. Total credit market debt reached nearly 350% of GDP. That means for every dollar the American economy produced, there were $3.50 of debt sitting somewhere in the system. That ratio matters enormously, because debt is not just a number on a balance sheet. Debt is a claim on future income. Every dollar borrowed today must be repaid with interest from money that hasn't been earned yet. When debt grows faster than income, the gap between what people owe and what they can realistically pay eventually becomes impossible to ignore, and then someone blinks. It usually starts small: a hedge fund in trouble, a bank that quietly stops lending, a bond market that starts asking questions it wasn't asking 6 months ago. The initial signal is easy to miss, but in a highly leveraged system, small shocks don't stay small. They travel, they amplify. What begins as a crack in one corner of the financial system becomes a fracture that runs through the entire structure. This is why crashes are sudden, not because something catastrophic happened overnight, but because the fragility had been building for years, invisible beneath the surface, waiting for a trigger. Here's the uncomfortable part. Every major institution tasked with preventing this cycle, central banks, financial regulators, international monetary bodies, knows this pattern exists. They have access to the same history, the same data, the same Minsky papers. The Federal Reserve employs hundreds of PhD economists whose entire job is to understand systemic risk. And yet, the cycle repeats. Why? Because intervening in a boom is politically and economically brutal. Raising interest rates when the economy is growing means telling people that the party is over before they feel ready to leave. It means lower stock prices, slower growth, angry voters, and a guaranteed headline about how the central bank killed the recovery. The incentives all point in one direction: let it run a little longer. So they do, and the boom extends, and the debt grows, and the fragility deepens. Zoom out for a moment. We are now living through what may be the longest period of artificially cheap credit in modern economic history. Between 2008 and 2022, interest rates across the developed world sat near zero for over a decade. Debt, global debt, reached $305 trillion in 2023. The entire world economy produces roughly $100 trillion a year. The ratio has never been higher. Interest rates have now risen sharply. Debt that was cheap to service is becoming expensive. Companies that borrowed at 2% are refinancing at 7%. Governments that issued bonds at historic lows are rolling them over at rates that consume an ever larger share of their budgets. American interest payments on the national debt are now larger than the entire defense budget. None of this means a crash is imminent. Timing these things is notoriously, almost professionally, impossible. But it does mean the structure of the global financial system looks in several important ways like it has before every major dislocation of the last century. The plateau always looks permanent until it doesn't. So here's the question worth sitting with. If this pattern is so well documented, if we have 300 years of evidence, dozens of academic frameworks, and a global infrastructure of financial watchdogs whose entire purpose is to monitor systemic risk, why do we keep arriving at the same place? Is it that we can't stop it? Or is it that somewhere in the architecture of modern finance, the boom and the crash aren't bugs? Maybe they're features. And if that's true, if the crash is not a malfunction, but an outcome that the system reliably produces, then the more important question isn't when the next one happens, it's who it happens to.